Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending August 18th, 2023. I'm Preston Brent. Thanks for tuning in. Well, the theme for the week is there more downside? I believe there is, but let's just take a look at where we've been this past week, and then we'll jump over the charts and just kind of see how things are starting to shape up here. So if we come in and look at the week, you'll see everybody's in the red. Year to date, everybody's in the green. Dow and the Russell are bringing up the rear. Nasdaq still a healthy performance, almost 27%. Nasdaq up just slightly under 14%. We did take a little bit of a lower sentiment blow from a sharp increase in longer-term bond yields and fears of a sharp slowdown in China. I mean, the only notable economic release we got this week was we did get July retail sales. On Tuesday, it jumped about 70 basis points over the month, which is double the consensus estimate. So that's given more credence to a stronger economy than most people think. Raised the prospect, or continued to raise the prospect, of a soft landing or a no landing recession scenario, i.e., basically the possibility that the economy could continue to expand without experiencing any kind of economic hard landing or a recession. I still think that's in the cards, but not until 2024. We did see also industrial production. It grew by 10 basis points in July. That was almost triple the consensus estimate. Although we did get Wednesday, which kind of started the sour mood along with China's economic growth or lack thereof, was the meeting minutes from the Fed's July policy meeting. It still seemed to suggest that there's still a lot of worry about continued growth signals, and most of the investors in the markets interpreted the Fed's meeting minute update more hawkish generally. So that kind of put the market in a sour mood. And that, of course, is along with the sharp rise in 10-year and 30-year note and bond yields. We did see the Atlanta Fed GDP now forecast came in at a crazy 5.8% for Q3. I don't think that's going to happen. The official estimate, is around 2.4. That's more believable for me. But we'll see how that thing plays itself out. But like I said, the 10-year Treasury yield, it's the highest level it's been since October 2022. Some of it, there's just a huge heavy issuance because the government now is just printing money like crazy. And there's also some supply worries out there around this. So that is helping boost the 10-year and the longer dated 30-year. You can see the valuations and volatility section of the screen on the right-hand side. The PE ratio is still basically flat from the 12-month trailing to the forward, but I think it's very high. I don't think it should be over 20, but that's what we're seeing right now. You got a dividend yield in the S&P at 1.55, 10-year Treasury at 4.25. It's higher by 270 bips. That's 2.7% higher than the dividend yield out of the S&P. And typically, when you get that divergence like that, then you've got the Treasury competing with equities for money because it's considered risk-free. So if you had billions and billions of dollars or a big fund, you may, park more than normal. You may go overweight 10-year Treasury or 5-year bills, those kinds of things, and just, wait out a potential storm over the next 12 months. So again, it's competing with U.S. equities for money. The earnings yield, you can see, is right at around 5%. The earnings yield over the 10-year Treasury is almost break even, about 77 bips, so not that much. The real yield is very healthy, 172 basis points, 1.72%. The current VIX, you can see it finished higher this week at 17.3. Remember, the prior week, a couple of weeks ago, it finished at 17.4. Last week, it closed out for the prior week at 14.84. But all in all, the VIX is still a teenager at 17.3, up about 16.5, a little bit over 16.5% for the week. You can see the best performer for the Weak, believe it or not, was technology, just barely above flatline. Worse is discretionary at 2.11%. Year to date, communication services leading the pack, and utilities bringing up the rear. Okay. If we flip over and go over across the pond, take a look at Europe. You can see Europe, they're all in the red. The Euro stocks, FTSE, CAC 40, DAX, all in the red. Year to date, we see the FTSE move back into the red year to date. Everybody else in Europe is relatively healthy. We did see UK wage growth accelerate. So that's going to continue to put pressure on the Bank of England to raise rates even further. I think they've had like 13 or 14 consecutive interest rate hikes of 25 bips. We'll see how they do. Meanwhile, inflation in Great Britain slowed to 6.8% from 7.9. So it's coming down like the rest of the planet, but it's still extremely high. I mean, 6.8 when 2% is their target. So we could see Great Britain hike their rates, the Bank of England hike them again. Also, part of the inflationary part there is services, and Bank of England considers their services inflation the best predictor of underlying domestic inflation. And that number came in actually higher at 7.4%. In fact, it's the highest level since March of 1992. So clearly there's going to be a lot of pressure on the Bank of England to continue their rate hike. So that's putting a damper on the equity market and the FTSE, which is, as you can see, they're underwater year to date. Meanwhile, if you go to the Asian markets, you can see the Nikkei down pretty solid 3.1% for the week. Year to date, still a very solid number, but the other Asian markets are not doing as well. China down for the week, just barely above flat line year to date. Hang Seng had a horrible week, both weekly and year to date, right? In Japan, one of the things that helped their GDP grew at an annualized 6% for the quarter on quarter in the last 3 months. Really, that far exceeded the expansion of 2.9% that the economists were forecasting for Japan. So a lot of that growth surge is driven by external demand. Keep in mind, Japan is competing with China for exports. Now, Europe and the US is punishing China and cutting a lot of the products that they buy from the Chinese mainland. So that's boosting Japan, right? They got to buy somewhere. But nonetheless, Japan rather, is doing very good. Their inflation is still elevated at 3.1% year over year. That's above the Bank of Japan's 2% target for 16 straight months. But Japan came out and said they still want to do a lot of stimulus. They want that target rate to be well over 2% for a year or two before they reduce their yield curve control mechanism. When they do, members, I will let you guys know. And I'll update you guys here in the blog, the weekend blog that's free for everybody, because that's when you're going to want to go long the yen. Right? It's just going to be a great run. Meanwhile, China, as I said, not very good for the week, not very good for the year. Chinese stocks continue to lose ground. Their country's flagging economic recovery is weakening as we're getting more and more data out of them. In fact, that's what turned the market south midweek here in the U.S. Right? Their industrial output and retail sales is growing at a slower pace than expected. A lot of analysts reducing their annual growth forecast. China's stated growth forecast for the year is around 5%, but analysts are bringing them down to lower than that. We did see Bank of China cut its medium-term lending facility rate by 15 points, but down to 2.5%. But most analysts say that's not enough. They're probably going to do more, but that's a little bit about what's going on over in the Asia Pacific area. So right now we're in the typical summer doldrums. What I'm going to do is I'm just going to switch the screen over and take you over to E-mini S&P 500 futures. Let me just get you guys over there real quick. Let me get this off my screen. We'll end this. And then what you're going to see here is just, I've had some target ranges here that have been here for a while. And I think they're going to stay here. You could see the yellow was the first near-term target, and then this one is a little bit further out in time towards the end of August. You can see we blew right through the first one, which is sitting also right on the 50 EMA. And the second one has got a range, but the midpoint of the range is 43.18. It dynamically adjusts as we move forward in time. The lower end of the range is around 42.73. The upper range is around 43.63, which is slightly lower than where we closed. The midpoint, which is what the system calculates, is around 43.18. Okay. So we're going to see how this plays itself out. You can see I've got a key price support level here at 43.05, and then I got a technical level, a fib node sitting at 41.74. So, and then right between these is the 200 EMA sitting at 42.10, right? So I think all of these are probably more than likely tested. Normally, when you get some kind of move like this, what you typically see is another counter move to draw some people in. So you have this move lower, then you get a little bit of a counter move, and then you have another move lower testing one of these lower levels. And this move here before it moves back up is what this is supposed to calculate, right? And the lower we go, then all of this shifts, more to the downside. That's what it does. So that's kind of what I'm seeing right now in these markets. Now, if I clear the screen up and then just put my measuring tool on here, just to give you a general prognostication, we're down from the highs about almost 5.5%. And remember, we made the highs on July 27th, all right? And we're down right at about 5.5%, roughly, give or take a couple of points. And my forecast was to pull back 4 to 8%. So we're down about 255 points off the highs that were made, as I said, on July 27th. So let's call it 5.5%. I was forecasting around, let's say the bottom side around 8%. And if we take it down to 8, that would take us right down just around the bottom end of this projected zone here. The 200 EMA is sitting right around 9%. That fib node here is sitting right around 10%, all right? So that would give us a normal correction. Keep in mind, we normally have at least one correction every year, and that's defined as 10% off the highs, or the recent highs. So that none of this stuff should surprise us. In fact, for our members, I was talking about cheap puts back over here. And I know a number of members are just picking up some puts as hedges to the downside. And some of our trade strategies work well in this market. So that's kind of what I'm seeing. If we look at the Dow, it has not pulled back as much as the S&P. You can see we're nearing my target here with the Dow. And if we just kind of do a back of the napkin pullback calculation, as you can see here, it's not even 4%, right? We blew through the 50 EMA, but we're not even at 4%, right? And then, of course, if we look at the Russell, let me find that on here. Where are we? I know you're on here. Well, let's look at NASDAQ first, and I'll get the Russell later. So if we look at NASDAQ, you can see here, now this pullback has been a lot more egregious. You can see my anticipated pullback zones go further out in time, right? You can see it's a wider range, and we're still not even near there. We've already blown through the S&P. And if we look at where we are NASDAQ from the high price this year, we are down right around 8.2%, roughly, from the highs made this year back on July 19th. So this, to me, I would expect a 10% pullback here, which would probably take us down to around our first anticipated touch point. And obviously, it's logical sense, right? Interest rates going higher. There's a lot of profits in NASDAQ, so there's a run to protect current profits, and then just shift and allocate money out of tech into other potential areas, value stocks and others that may weather this drawdown a little bit easier than others, right? If we look at the Russell, you can see here on the Russell, again, we've actually blown through my targets for the Russell, and it's sitting right on the 200 EMA, right? And if we look at that and just kind of take a look at the back of the napkin, roughly around 7.6% for the Russell, near the Dow or the Nasdaq. But we're sitting on that. Should that break, then we're probably going to come down and test this area down here, which is the closing price of last year. So anything north of this line here, we're in the green for the year. So that's a little bit about what I'm seeing, right? And of course, if we look at the FANG index, this is the one that drives a lot of the energy in the markets. You can see we're coming down to my target right here in the FANG index, right? Now it hit a high on July 27th, and we look at the index. These are the big guys, and we just kind of see where they are right now. It's down about 7.78% as well. So, and of course, if we look at Apple, Apple controls a big part of this. You can see the undoing of Apple. It was 182.86 is when Apple's worth 3 trillion. So it's slightly below that 3 trillion net worth level. But you can see where we are right now. We're down just about 11.4% roughly in Apple. So again, a little bit of a pullback here makes a lot of sense because we were up a good deal year to date with some of these FANG stocks, right? If we look at volatility, if we look at the VIX right here, as soon as I get it on the screen here, you can see the VIX pull back a little bit on Friday, but you can see that surge higher. It's been generally in the upper boundary of this green zone, which kind of dividing line is 15 into the yellow zone, and then the dividing line into the light red is around 20. So we've spent a lot of our time here post-COVID, and very rarely do we stay in the upper boundary of the green for a long period of time, which is, around 14, 15 zone, right? So you can see how we bounced up here on this. If we look at the front month vol skew, which compares the VIX to October, you can see we're still in the green. I mean, we're in a contango, so that's a normalized market. The markets aren't too fearful. And if we look at the back month skew, which compares September to October vol futures, again, in the green. And then if we look at the 3-8 month or the 2-8 spread, which compares October to April vol skew for the futures, you can see here we're solid in the green, right? Well in the green. I mean, when this goes into the red is when we're, in a correction territory and it could get more ugly. So right now, I don't see the volatility market anyway suggesting if it does pull back a little bit more, it's more of an orderly pullback, right? And then, of course, if we look at bonds, it went up a little bit. In fact, we're nearing the 2022 lows right here. So there'll be a little bit of support here for this. But this is the bond market hit a low right over here on August 17th. And remember, the lower bonds go, the higher interest rates go, and it's just rolling over. And if we do look at the 10-year rates, you can see here closed at 4.251. We're challenging the 2022 highs. In fact, we came right up to that level on Thursday and pulled back just a little bit on Friday, okay? But you can see that this is as a consequence of all that debt issuance that the feds are doing. They had to do 1 trillion in new debt auctions from the midpoint of this year through the end of the year. That's huge. And in addition, they're not at the auction window buying. It's left up to others. And about 70% of the purchases right now are U.S. based, believe it or not, mostly professional money as well as retailers. So they're taking advantage of the higher rates, buying. And that money comes out of U.S. equities, probably some profit taking, and going into some very low risk or no risk type U.S. Treasury. So that's what we got going on in the bond market and the interest rate market. And then, of course, if we look at currencies and we look at the dollar in times of stress, it always goes higher, right? So as long as the global economy and most markets are in stress, the dollar's moving up. We hit a low on July 18th. We were only down 3.87%. But we've just been, and that's kind of when the markets In the summer doldrums, middle of July into August, September timeframe. I expect this to end going into October. So I still think we've got the odds favor more downside, right? But that is typically bullish the dollar and bearish the euro. So if we look at the euro, it's going to be just the opposite. You can see the euro is coming down. It's spent about 3 weeks, roughly 2.5 to 3 weeks testing the 50 EMA, could not get over it. Now it's going to probably come down and test the 200 EMA, which is sitting right at the 2022 closing value for the euro. It may have one last gasp up and then kind of a counter cyclical move and then move down, and that'll be it. And then we're going to want to enter long again. We've had 2 long trades in the euro this year, both of them home runs, right? Good money in them. Right now, I'm standing down. I want to just see how this thing plays itself out. I think the euro longer term will be bullish, but short term, through we get through this mess through the end of this year into Q1 of next year, we got to see where the euro is going to want to go. And then, of course, same thing with the yen. We're going to follow that very closely. Not time to buy yet, but it's coming down to my target right down here. And once it gets down here, and there is no divergence that suggests any move higher, is more subject to a rollover than anything else. But the minute Japan releases their yield curve control that the Bank of Japan has got on the financial markets here, you're going to see the yen go up, and it's going to be a great trade. So we'll be ready for that. You're not going to catch it at the peak, and you're not going to get it at the trough. In this case, the trough, but we're going to want to jump in because it'll run for a year when they do that, right? So it's a little bit about what I'm seeing there. And then, of course, if we come over and look at metals, gold is nowheresville. I think gold, if anything, is probably going to just drift down to the 200 EMA, maybe even a little bit lower. I got people short gold back over here in May timeframe, taking the short trigger that we had here. But outside of that, I think gold's going to go lower. And it'll be the same thing if we look at silver too. Silver is just going to roll over. It's testing this area here. Should it break, it'll come down much lower. And I think the odds favor that right now. All right. Of course, if we look at copper, wherever China goes, copper goes the same. And if I just kind of back it out a little bit, you can see this regression channel. This was my target for copper down at that level down here. But you see we get too far from the mean in this regression channel, and then we come back to the mean. And now that's kind of where we are, so we'll probably run up a little bit. We're going to see the 50 and the 200. The 50 is the red line. The 200 is the yellow line. It'll run right into that resistance there and probably run right back over again. Of course, if we come to oil, oil's been doing fairly good lately, right? If we look at oil, you can see it's had a good run off the June, July timeframe. Like the U.S. dollar, typically when the dollar gets stronger, it puts a little bit of downward pressure on oil, but with the production cuts out of OPEC, we're seeing oil and gasoline coming higher, right? We had a high here on August 10th, just a few week ago. It was up 4.4% for the year because we've been down most of the year because oil had such a strong year last year. So we're going to bounce around here. We may have one final push up, and then I'm going to want to short oil, right? Gasoline, which is going to continue to add to the keep high inflation higher. I mean, look at gas. It hit lows down here going into this year, and then gas has been very choppy. And then coming off the most recent significant pivot low was back here in May, and then we're all the way back up to this level again, right? So that's going to keep gasoline prices higher for longer. But we had a wonderful trigger pretty much pop up on the 15th, 16th here with that divergence. It's probably going to come down and test these levels down here, and then we'll see how gasoline fares, right? All right, everybody, that's a little bit of some of the major indexes. Members, I will go through some stock opportunities as well as a little bit more detail on some of these things and where I see the markets heading through the remaining part of August into September. All right, everybody, have a great weekend. Members, I'll see you Sunday evening for our weekly market watch. Take care, folks. Ciao now.